Welcome to TalkTickers. You're tuning in for your quick, insightful breakdown of the latest financial pulse. Today, we're diving into the MetLife first quarter 2025 earnings call. We'll pull out what really mattered.
Yeah, so MetLife reported adjusted earnings of $1.3 billion for Q1. That works out to $1.96 per share.
Okay, $1.96. How does that compare?
Well, it's actually a solid 7% increase compared to last year. Quite a few things helped here. Favorable underwriting, decent volume growth, and better variable investment income. 7.
But not all smooth sailing.
No, not entirely. They were sort of dragged back a bit by unfavorable foreign currency exchange and some pressure on recurring interest margins.
Okay, and key metrics like ROE?
The adjusted return on equity came in at 14.4%, and the direct expense ratio was 12%.
Right, 12%. Let's hang on to that number.
Yeah.
Okay, a solid overall picture then. Let's dig deeper, maybe start with group benefits. That sounds like that area did particularly well.
It really did. Adjusted earnings, there were $367 million.
Wow.
Yeah, up a hefty 29% year over year.
29%? What drove that?
Well, the main thing was favorable life underwriting margins. Seems it was down to lower mortality in the working age population.
Interesting. Lower mortality.
Yeah, they even mentioned it lines up with recent CDC data. The group life mortality ratio specifically was 84.8%.
Okay.
Now, their adjusted PFOs, that's premiums, fees, other revenues, were up 2% overall. But if you strip out the impact of some participating life contracts, because of fewer death claims, the underlying growth was actually more like 4%.
So stronger underneath than the headline 2% suggests.
Exactly. They did flag seasonally high dental utilization, and some rate actions they took back in January had a bit of a knock-on effect on persistency.
So keeping customers on board got a little trickier.
Temporarily, yeah. But they expect those rate changes to help earnings down the line. For the full year, they're forecasting PFO growth in group benefits somewhere in the 4 to 7% range.
Okay. That lower mortality, though, it's great for the
bet.
quarter, but is that, sustainable? Seems like a bit of an unknown.
That's a really good point. It's definitely a positive now, but you're right. A sustained dip like that is unusual. It could normalize or even swing the other way. It highlights that inherent unpredictability in life insurance, doesn't it?
Absolutely. Okay, let's switch gears. What about retirement and income solutions, the RAIs segment? How did that look?
RAID was a bit more subdued. Adjusted earnings were $41 million.
$41 million increase.
Yeah, but just a slight one, up 1% year over year. The growth came from higher variable investment income and some favorable underwriting that helped offset those unfavorable recurring interest margins we mentioned earlier.
Right.
They did see good momentum in sales, though. Strong sales of synthetic GICs.
The synthetic GICs. Maybe just a quick reminder what those are.
Sure. They're basically investment contracts that are designed to act like traditional guaranteed investment contracts. So strong sales there, and also in UK longevity reinsurance. Plus, they pulled in a pretty significant $1.8 billion in pension risk transfer inflows.
From big games.
Yeah, Fortune 500 sponsors looking to offload pension liabilities. So there's definitely demand there. Their total liability exposure grew 8% year over year. And looking ahead, they think full year liability balance growth will be, towards the upper end of their 3 to 5% target range.
Okay, so growth in liabilities, but what about profitability? You mentioned margin pressure.
Yeah, the core spread, that's a key metric. The difference between what they earn on investments and what they pay out, it did dip sequentially.
Why was that?
A few things. Interest rate movements, some interest rate caps rolling off, also pay downs in some higher yielding structured securities they held.
So less income from those higher yield assets.
Right. But they did take some management actions to partly offset it, and they expect the spreads to kind of level out, stabilize in the second quarter.
Okay, so some puts and takes in RAISA. How did MetLife fare internationally? Asia first.
Asia. Well, adjusted earnings, there were $374 million. That's actually down 12% year over year.
12% down. Ouch. Currency impact.
Yeah, on a constant currency basis, it was down 9%. So currency was a factor, but not the whole story. The main issues were less favorable underwriting margins this time around, and also a deferred tax asset adjustment they had to make in Japan.
Okay. But what about sales? Were people still buying policies?
Actually, yes. Sales for the region were up 10% on a constant currency basis.
Oh, interesting. So underlying demand is still there.
Seems so. Particularly strong growth came from Korea and China. That helped make up for a drop in Japan's sales.
What was the issue in Japan?
Pressure on their foreign currency products, mainly due to the yen's volatility, made those products less attractive.
Right. Makes sense.
But on a positive note for Japan, they launched a new US dollar product through the banker channel, and they said it's showing, good early momentum, so maybe something to watch there.
Oh, yeah, a bit of a mixed bag in Asia then. What about Latin America?
Latin America reported adjusted earnings of $218 million. Now, that's down 6% year over year as reported.
Great. Constant currency.
But up 7% on a constant currency basis. So underlying performance was positive. That growth came from higher business volumes and some favorable tax items. Those helped offset less favorable underwriting and lower returns from their businesses in Chile and CA.
And revenues.
Adjusted PFOs were up only 1% as reported, but a really strong 14% on a constant currency basis.
14%. Okay, so strong underlying momentum there too.
Yeah, definitely seeing good traction across their leading markets in LATAM.
Okay, stepping back from the individual segments.
Yeah.
What else stood out from the call? Any big picture stuff?
Well, MetLife Investment Management, MEM, is definitely ambitious. They're talking about being on a path to $1 trillion in assets under management.
$1 trillion. Wow. How are they getting there?
Well, they integrated the Mizero acquisition they did. And they said the PineBridge acquisition, which is about $100 billion AUM, is progressing well.
Right. Growing to acquisition. What about capital return? Shareholders like that.
They returned about $1.8 billion to shareholders just in Q1. That was $400 million in dividends and a hefty $1.4 billion in share repurchases.
$1.4 billion in buybacks in one quarter.
Yeah, pretty significant. They did signal the pace might be a bit more measured going forward, though.
Okay, understandable.
But they also announced a new $3 billion share repurchase authorization. So adding that to what was left, they have about $3.4 billion authorized now.
Plenty of firepower left. And dividends.
They bumped the common dividend per share up by 4.1%. They also did some balance sheet management, issued $1.25 billion of pre-capitalized trust securities and $1 billion of subordinated debt.
Okay, and cash levels.
Holding company cash and liquid assets ended the quarter at $4.5 billion, which they said is comfortably above their target buffer.
Good position. Now, that risk transfer deal you mentioned briefly, the one with Talcott Resolution, that seemed pretty important strategically.
Absolutely. That agreement to reinsure about $10 billion of their U.S. retail variable annuity and rider statutory reserves with Talcott is a big move.
Why do it? What's the goal?
MetLife basically framed it as accelerating the runoff of their legacy business. It reduces risk for the whole company and specifically cuts down that, tail risk associated with variable annuities, which can be quite volatile.
Makes sense. Is there a financial impact?
Yeah, they expect it to deliver about $250 million in statutory value. But on the flip side, they'll forego about $100 million in annual adjusted earnings from that block of business within MetLife Holdings.
Okay, so a trade-off. Earnings hit for less risk and some capital value.
Right. But that earnings hit is partially offset. They figure about $45 million in annual hedge cost savings.
Okay. So the net earnings impact is smaller.
Exactly. And another angle is that MetLife Investment Management gets to manage about $6 billion of assets for Talcott as part of the deal.
Oh, interesting synergy there. So MAM benefits too.
Right. And the overall effect is a huge reduction in MetLife's total variable annuity balances. They expect them to be down over 50% since 2019 after this.
50% reduction. That's significant de-risking.
It really is. And, it could be part of a wider trend. You might see more insurers looking to offload these non-core or volatile legacy books to free up capital and focus elsewhere.
Good point. Okay, what about their investment performance? We touched on variable investment income earlier. Any more detail there?
Sure. Pre-tax seventh was $327 million in Q1. That was up from the previous quarter, but still running a bit below their sort of average quarterly run rate.
And the breakdown.
Within that, private equity returned about 1.6%, and real estate and other funds yielded around 2%. They did get about $600 million in distributions from PE.
Okay. And looking ahead.
Given all the market uncertainty right now, they're holding off on specifics for Q27. They plan to give some preliminary info on that in early July.
Right. And expenses, you mentioned the 12% ratio earlier. Are they sticking to their targets?
Yep. Q1 was 12%, and they reaffirmed the full year target is still 12.1%. So keeping a tight rein on costs seems to be a priority.
Good to hear. And finally, did they comment much on the wider economic picture, strategy, that sort of thing?
They did. They acknowledged, the rising possibility of a recession, ongoing market volatility, standard stuff, really.
They're confident.
Yeah, they express confidence in what they call their all-weather strategy. Said they're focused on executing their current plans, no big changes expected on capital management. Expense control remains a key focus, as we just said.
Anything else notable?
Yeah, a couple of other things. They mentioned the new economic solvency regime, ESR, implementation in Japan effective April 1st.
How'd that going?
They feel good about it. Said they were operationally ready and that it aligns pretty well with the economic framework they already use for pricing. Importantly, they don't expect it to change their dividend policy.
Okay. What about the pension risk transfer market? Any impact from volatility?
They think that while, excessive market swings might be a temporary distraction for plan sponsors, it probably won't derail the pipeline for the big jumbo transactions because those sponsors are usually pretty well hedged.
Right. The big deals should continue.
That's the view. And lastly, an update on Cherry Tree Re. That's their joint venture reinsurance company with General Atlantic.
Yes, Cherry Tree. What's happening there?
They said progress is being made to get it capitalized and operational. They're aiming for a launch around mid-year.
And the goal with Cherry Tree Re?
Basically, to create a long-term partnership. It gives them more capital flexibility and lets them write more liability growth than they could just using MetLife's own balance sheet.
Interesting. Okay, that's a really comprehensive overview of MetLife's quarter. Thanks for breaking that down. Now let's pivot to our This Is Not Financial Advice segment. Time to get a bit creative, maybe even a little outrageous, with a trade idea sparked by this call. What have you got?
Okay, so really leaning into the not financial advice part here. But think about this. MetLife just made a huge move dumping a big slice of that variable annuity risk.
Yeah, the Talcott deal. Big de-risk.
Exactly. And at the same time, they're doubling down on shareholder returns, bigger dividend, massive buyback authorization. So here's a thought, maybe a bit contrarian. What if, instead of just buying the stock, you looked at something with more leverage? Like perhaps acquiring a decent block of longer dated, out-of-the-money call options on MetLife.
Calls. So betting on the price going up, but with leverage. Why?
Well, the thinking is, by shedding that VA risk, maybe MetLife's earnings become more predictable, more stable, and maybe the market starts to re-rate the stock higher because of that.
Okay, I see the logic. Less perceived risk could mean a higher valuation multiple.
Potentially. These calls, yeah, they're speculative, but they give you huge upside potential if there are positive surprises, or even just if the market shifts towards more stable financials.
But call options are risky, and you need funding.
Right. So, to add another layer, and this is where it gets really speculative, maybe you fund buying those MetLife calls by simultaneously selling short a basket of, say, meme stocks.
Whoa, okay. Shorting meme stocks to buy MetLife calls. Explain that.
The idea, purely theoretical, remember, is you're betting on two things. One, a potential flight to quality benefiting stable players like a de-risked MetLife. Two, you're betting against the, let's say, questionable or potentially unsustainable valuations of some of those highly volatile social media driven stocks.
So a pair trade, essentially.
Yeah.
Long perceived stability, short perceived froth.
Kind of. It's definitely high risk, high reward. You need a very strong stomach, a deep understanding of options, and the significant risks involved in short selling. You could lose a lot fast.
Absolutely. Definitely not for the faint of heart, and certainly requires homework.
Totally. It's just a thought experiment, connecting the dots from the earnings call in a perhaps unconventional way. As always, do your own thorough research before ever considering anything like this.
A bold strategy for sure. Thanks for that. So reflecting on the call, what were your main takeaways? And for you listening, what stood out? What other earnings calls should we tackle next? Let us know your thoughts.